After markets hit a new all-time high today, you have quickly reset to the downside with a lot of concerns over the economic data that came out today. Lots of concerns of overcrowding in AI/big tech stocks and election concerns following the presidential debate that happened last night. And as investors like Tom Lee and Mark Newton over at Fundstrat, some of, if not your most prominent investors and most correct investors today, are starting to call for more upside. Is this the time to be a little defensive? All of this and much more in today's episode. Worth mentioning again from the Goldman Sachs desk today, they say, quote, "The first 15 days of July have been the best 2-week trading period for the S&P since 1928. But you could also say this year has been a statistical anomaly when you look at many different data points, including the outperformance of the S&P relative to the equal weight S&P or the outperformance of the S&P relative to the Russell. It's one of the worst years on record of the S&P outperforming the Russell. So to the same historical precedents, you could say the beginning part of July is seasonally a very bullish time. You could also say this year's kind of abnormal. This year's also abnormal in the sense that we have really not seen much of a pullback. During normal election years, on average, you see a pullback of about 13%. Sometimes larger, sometimes smaller, but we've only seen a pullback of about 5% so far. That would be a statistical anomaly. So as we actually get closer to the election itself, there can be a little bit more pressure on markets. And as we've seen with this earnings season so far, there is zero room to disappoint, with stocks like Nike falling 20% today in a move that you have not seen on Nike in almost 10 years. Stocks are priced for perfection, and that is what we need from markets to continue higher. And from Gunjan Banjiri over on X, she covers money and markets for the Wall Street Journal. She says the S&P 500 has outpaced its equal weighted version, which is less reliant on heavyweights like Nvidia and Microsoft, by 11 percentage points this year, on pace for the largest outperformance through June of any year since 1990. Capital Economics has raised their S&P 500 price target from an initial price target of 5,500 up to 6,000 today. They have also set a 2025 price target of 6,500 to 7,000, which those levels are possible, but you have to see record high expectations 2 years in a row met and then actually exceeded on. At the same time, the Fed actually engineers a soft landing and does not make a policy error. So-called Supercore PCE is up 3.4% year over year in May, down from 3.5% in the prior month. Fed Daily today said inflation is still too high. This morning, we did have a lot of data that came out, and it was mixed across the board. Core PCE month over month for last month was revised higher from 0.2% up to 0.3%. The expectation for the month of May's month over month number, so the data that we were getting this morning, was 0.1%. You came in at 0.1%. But when you consider that last month's revision, it's not nearly as good as we would hope for. Personal income month over month went up 0.5%. Last month, it was up 0.3%, and we were expecting 0.4%. So that came in higher than expected. Personal spending was revised lower from 0.2% down to 0.1%, and we came in at 0.2%. The expectation was 0.3%. So personal spending revised lower for last month, came in lower than expected for this month. When over 70% of economic activity is dependent on people spending money, spending data coming in soft doesn't really bolster the expectations that the S&P will actually deliver on the lofty expectations we have for EPS this year, and maybe not for next year either. And definitely companies like Nike cutting their full year guidance also does not help the lofty expectations. Chicago PMI came in higher than expected by quite a bit. You came in at 47.4. You were expecting 42, and last month you were 35.4. 4. So that was some welcome news on the economy. 5-year inflation expectations, as per the final numbers for the Michigan Consumer Sentiment Survey for the month of June, came in at 3%. We were expecting 3.1%, and last month's reading was 3.1%. So that was some welcomed news there. 1-year inflation expectations also eased a lot, coming down to 3%. We were expecting 3.3%. So very positive news from the inflation front, or expected inflation. Consumer expectations came in a little bit better as well. We were expecting 67.6, and you came in at 69.6. And current conditions came in a little bit better as well, coming in at 65.9. We were expecting 62.5, although the previous number we had was 69.6, still quite a big drop from the last estimate. So I would say across the board today, it was a lot of mixed data. If you're a bull or you're a bear, you can point out things that you like here or you don't like. It's really a day for everyone. And that's why I do think you initially hit that brand new all-time high today and then came right back down, because just as good as today's data was, it was equally as bad. And I really can't sit here and say this was a definitive good day or bad day for the markets in terms of the actual data that we did get. But yes, if you are a bull and you want to point to something, PCE and core PCE continued the downward trend. Goldman Sachs just reported that hedge funds are aggressively offloading tech stocks at a rapid rate we have not seen in years. And June so far is already a record month for this offloading. This is info, tech, and communication services. You can see at the lowest level in at least the last 5 years. Well, 7 years technically. This chart goes back to 2017. And you just came off of some pretty good inflows over the last couple of months. So this is a big reversal. And again, this is all happening at the same time stocks just hit a new all-time high, in which those tech sectors, communication services and info tech, are really the areas that drive the broader markets higher or lower on a market cap weighting. I think that's a warning sign. Correct me if I'm wrong, but that looks like a warning sign. Now, do the markets have to go to crap? Absolutely not. In recent days, as Nvidia and others have started to sell off, we have actually started to see a rotation into other areas that have been more beaten down in recent months. Take a look at Dollar General today, that is outperforming. Select areas of healthcare, also outperforming today. Overall, the value trade could start to catch a bid here, and you could start to see a broadening out of our markets. That's the bull case scenario, is you just get a broadening out and there's no major correction. The bad case scenario is the economy gets worse, selling continues in big tech, driving markets lower, and you don't see much of a rotation. Here you can actually see today the percent of stocks trading above their 50-day moving averages is green today. 1.5% of all stocks are breaking above their 50-day moving average. So today's actually a really good day. I want to correct myself. It's not a really good day. It's an okay day for breadth. You're still in a pretty bad place. The markets are not participating a lot with the upside that we've seen lately in the S&P or the NASDAQ, but it could be a lot worse. You currently have 43.52% of stocks trading above their 50-day moving average. That means about 57% of stocks or so are currently in a pretty severe downtrend below their 50-day moving average. So it's not great by any means, but it's not getting worse. In the last couple of days, you have actually went from a low of 35.5% of stocks above their 50-day moving average up to where you are now at 43.5%. So that's decent. There definitely is a case to be had that there is a broadening out, at least starting in our markets. Jason Govert writes on X, watch credit spreads. The spread between the weakest and strongest investment grade credits bottomed nearly 2 years ago. Credit concerns are rising even as stocks hit record highs. This is unusual and was last seen in late 2021. And that's where you can see in this blue, you're starting to get spreads that are going higher, and when the spreads actually start to narrow themselves, right, when you start to get a big rise in this blue line, that's where you start to see that correlate with some weakness in markets. Specifically during this period of time was January of 2022, and really this start that kind of what we're seeing here was the last month or so in 2021, which did precede a very bad 2022. Good news is if the markets do start to fall, the Fed's going to U-turn, they're going to start to cut rates. The bad news is if the Fed starts to cut into a falling market, into a weakening economy, on average that leads to a pullback of about 23%. Due to markets being at all-time highs and expectations being sky high, you could make an argument this time could be a little bit larger, especially if there is more of a recession concern. But again, is this a guarantee? Absolutely not. But are the risks balanced in our markets? Absolutely not. Meaning the risk is not balanced where stocks can go higher or lower on a equilibrium type of odds, right? The odds are not 50% that stocks go higher, 50% stocks go lower. Based on expectations, based on the Fed that is being stubborn, does not want to start cutting rates as the economy is weakening, there's a much greater chance that you could see a pullback here of a larger scale than maybe any other time we've seen over the past 6 months or so. So I still think it is time to be a little conservative, but yes, at the same time, I do see the argument that could be made. You could just see a rotation, right? Maybe big tech does fall a bit, but maybe that money just goes into other areas of the markets. That's why I think the data is very important to be watching here as far as the economy, because the economy is going to make all the difference. If the economy holds up, you will see a rotation, not an outright collapse. If the economy gets worse, if some of these leading indicators that we are seeing, like credit spreads, like the outflows from tech that I just mentioned here in this video, are actually leading indicators of the economy getting worse, which they could be, then you're not going to see a rotation. Then you're just going to see outright selling, because the last places that are going to see a recession or a rotation, if there is recession concerns, are consumer staples, are discretionary, I guess I shouldn't say consumer staples, but discretionary like names. Those are not going to be the areas that see the rotation. And no, people are not going to load up on value if it looks like we're going into recession. I think it's a little premature for markets to come to that conclusion, but give it just a couple more bad data points and you could see a lot more fear start to build. Again, you don't have to go into a recession for recession fears to start. Right now, the S&P and the NASDAQ on a headline basis are not pricing in any chance of a recession. If the chance of a recession rises from, let's say, today at 0%, again, judging off of EPS estimates for the S&P 500 this year and next year, being the number one factor, there's others, but we'll just stick with that. If the odds rise to 10 or 20%, that could mean substantial downside from here, let alone 30, 40, 50%, which I think is really, in all reality, where we're closer to. And this is what a lot of people have pointed out as well. You can see American excess savings reached a high of 2.1 trillion in 2021, but they ran dry months ago. So essentially what could happen, and Mohammed El-Arian on CNBC pointed this out a couple of days ago. I'll find that clip and put it in a video over this weekend, so subscribe to the channel because you definitely don't want to miss that. You could see a rapid slowdown if a slowdown does actually start. It may not be some kind of slow, gradual slowdown because people just don't have savings left. Bank of America said today, if you thought hedge funds were positioned defensively back in Q1, at the top of this chart, they have only become more skittish, most defensively positioned in history. This on top of the lightest exposure to equities since 2009. So another warning sign potentially that stocks may be mispriced. And in fact, back to that point of excess savings, you're actually negative $170 billion in excess savings. So people not only don't have money in their bank accounts, they're actually going further in debt with no money in their bank account. Yardini says weakness in the labor market, quote, one important reason why we aren't concerned is that private payroll employment is driven by profits, and S&P 500 forward earnings continues to rise to record highs. Profitable companies tend to expand their payrolls. Fed Daily says today we'll continue to see inflation print above 2% through 2025. That doesn't sound great either. And since everyone's talking about the election, specifically the debate and what outcome this could have on the markets, we might as well mention it here in this video. This chart is from Bespoke. It says election betting odds have President Biden winning down to 21%, while Newsom is at 9.2%. Note the electoral votes odds have swung to 312 GOP, 226 Dems. Trump has a 59.7% odds of winning, Biden at 21.3%, Newsom at 9.2%, and Harris at 4.6%. I like to stay as apolitical as possible here on this channel. I like to stay as neutral as possible. This is all about money. And in the grand scope of things, it doesn't matter who wins the White House. It really doesn't. Stocks have tended to do well no matter who is in the White House. But there are some things worth mentioning. Again, on average, there is a pullback of about 13% during an election year. Normally, right before the election or within the 3-month period before the election. Although it can happen sooner than that, you do tend to see a pretty large pullback, and you have not seen that yet, so statistically, you're probably going to see that. And while there is going to be a lot of fears around what could happen, this or that, it's probably not going to materialize into anything meaningful. If we do see a crash in markets, it's not going to be because of this guy or that guy for the White House. Although there are a lot of calls that Biden should just step down and let someone else try to win the presidency, if that were to happen, that could mean a little bit more uncertainty because, I mean, we kind of know what to expect with Biden, what to expect with Trump. That gives you a little bit more certainty. And that's why I'm not as concerned this time around about election pressures on markets. There's not that much uncertainty. We already know what to expect. If someone else were to theoretically be brought in, which seems like a low chance at this point, to replace Biden as running for the Democratic part of the White House, then that could bring a little bit more uncertainty, and that could spark a little bit more of a sell-off theoretically in markets. Here today, sentiment for the S&P 500 is bearish at 39. Yesterday, it was bullish at 73. Message volume is higher today than it was yesterday. Today coming in at 70. Yesterday, it was at 55. And the participation ratio of today is normal at 53. CNN's fear and greed indicator today is at 45, which is still barely neutral, just out of fear territory, which if you go down 1 point, you're going to technically be in fear. So there is still a decent amount of fear out there. Yesterday, you were neutral at 46. You do have the components of CNN's fear and greed index: market momentum, extreme greed; stock price strength, extreme fear; stock price breadth, extreme fear; put and call options, extreme greed; market volatility is neutral; safe haven demand is fear; and junk bond demand is also fear. Based on the data that we got today, the Atlanta Fed GDP Now tracker's estimate for Q2 GDP is kind of plummeting from 3% down to about 2.1%, which is a pretty big move down for just, 1 day's worth of data. And 10-year Treasury yields today are up almost 6 basis points. The odds of the first Fed rate cut coming July 31st are back down to 10.3%. Yesterday, they were at about 12.5%. So the odds of a cut coming July are actually falling. The 2-year Treasury yield today is at 4.71%. The 10-year Treasury yield today at 4.34%. That means the 10 2-year yield curve inversion is actually uninverting quite a bit today, only inverted now 37 basis points, which even yesterday you were inverted 41 basis points. Now what tends to happen is before you go into recession, you go inverted on the yield curve, but then you actually go positive. When you go positive is when you are pretty much entering into a recession. So that's also something the markets are looking at today and saying, that doesn't look good. Overall, the S&P 500 still has an RSI of 70.2, so you're still on the overbought side. And as some people have pointed out here, since about the start of June, you've actually seen oil go up quite a bit in value from a low around the start of June to now up almost 13.5%. That is probably going to cause a temporary hike in inflationary pressures, because oil touches everything, no matter what it is. No matter if it's this cup, if it's this kid medicine, doesn't matter what it is. It was shipped, transported using oil in some way, shape, or form. So oil is an input cost to every company in the world. With all of this said, let me know what you think is going on today, what you think is coming next for markets. Are you defensive? You buying some puts here? You going all in? Let me know what you think down below in the comment section. I think the big question really is rotation here or outright correction here. Let me know what you think about just that down below in the comment section. You guys have a fantastic rest of your day. On the way out, hit the like button as well as subscribe to the channel. Thank you for watching. Most importantly, enjoy your weekends, and I will see you in the next one.